Okay, in Chapter 4, we're going to be taking a look at the individual income tax overview, these things called exemptions, filing status, and we're also going to look at standard deduction amounts, and that was what our learning objective 3 from Chapter 6 deals with. So here is the individual tax formula. And if you have a copy of a 1040 in front of you, and you could pause this and download one from the irs.gov website, or there's one in the back of your chapter. The tax return, the 1040, is set up the same exact way. Gross income is on the front page of the 1040, and it's in lines 7, and I'm grabbing mine, through 21. Those are all the lines that you would include income that's taxable. Then from there, the next lines, we deal with computing income tax liability, which is line 44. So we determine taxable income, that part of our income that actually we need to compute income tax on. We determine it. We saw that back in Chapter 1. We also can use tax tables, and that equals our tax that we owe on that income. Now, from there, we subtract tax credits if we have any tax credits. And these are determined in line 48 through 55, and there are some down through 64 through 73. Okay, so these are items we can deduct that we don't have that from our tax bill. Also, we subtract any prepayments that are made. So if a taxpayer pays money in through their employer, so they have federal income tax withholding, that's a prepayment. Some people pay money directly to the U.S. Department of Treasury to cover their tax bill for the year. Okay, so all of these items are then subtracted, and ultimately we get to line 75. That's a refund if your prepayments and credits are greater than total tax. And then it's a tax due if the amount ends up being positive after subtracting credits and prepayments. And that would be reported on line 78. So I just want to show you how that emulates the 1040 itself. Now, Individuals report taxable income again on their 1040, and we have what's called the all-inclusive concept. Code section 61 of the Internal Revenue Code says all income is taxed. All income, unless it's specifically stated somewhere else in the tax code that it is not. So we're going to be defining, coming up in chapter 5 and chapter 6, what are these items that are specifically excluded. So that's how we have to define what is actually taxed. Realized income is normally the part that is taxed, or I should say it's part of the part that's taxed. This is a measurable change in property rights. All realized income is included in gross income unless specifically excluded or deferred. Let me just give you a quick explanation on that, and you're going to see this. When, well, I should say, if you are a beneficiary on a life insurance policy and you receive money due to someone's death, say $100,000, you're the beneficiary. That money is specifically excluded from ever being taxed. So you receive that income, it's realized income. You had an increase in property rights, but it's specifically excluded due to the nature of the item. Deferred is a little different. Deferred income is that you may earn the income now, but you're not taxed on it till later. An example of this is a retirement plan. The most common type of retirement plan is called a 401k. So if you ever hear that term, they're talking about a retirement plan. 401k gets its name from the code section in the Internal Revenue Code that governs it. That's where the law is about this retirement plan. And it basically says this: the money going into the 401k, whether it's from an employee or an employer, or it's just the earnings on the retirement plan itself. So 401k is funded normally by the employee. As the employee puts money into that, so they are usually funding it from their current paycheck. So maybe they say, put 5% of my current paycheck into my retirement plan 401k. The employee is not taxed on those earnings when they earn them. So that part of their money that goes into the 401k for their retirement is not taxed currently. Same with any employer contributions. Any earnings that are occurring while they're saving. So if the 401k is earning interest or dividends, not taxed. When the employee retires and starts taking the money out, that is when they are taxed on the proceeds, their retirement income. So we call that a deferred tax situation. It is earned now, put away now, not taxed, but it will be taxed later. Excluded and deferred income not included in gross income. We said, here are some examples. Income never included in taxable income. Municipal bond interest, we saw that in chapter 2, and we're going to see, or chapter 1, I'm sorry, and you're going to see a whole bunch of them. Deferred income we just explained, and there's 2 more, something called an installment sale and a like-kind exchange, and we'll explain those in full. But I think the 401k is the best illustration right now, because I think we're pretty familiar. We've heard of it at least. The character of the income or loss is also very important. And we have to introduce this now so that you understand not all income is taxed the same. Tax exempt, of course, no tax. Tax deferred, no tax till later. Ordinary income. Ordinary income is taxed at your normal tax rates. Now, ordinary income is most income you earn or is involved in a business situation. And we'll be defining that more. But when you hear this term ordinary, that just means you use normal tax rates that you have to compute the tax. Dividends, special dividends called qualified dividends, and we'll explain those later on, they're taxed at special lower rates. And so are certain capital gain or loss. Now, capital gain or loss results from the sale of a capital asset. A capital asset is not defined in the Internal Revenue Code. It is kind of defined by exception. If it's not this, then it's a capital asset. I know it's very odd, but that's how it is defined. We'll look at it in a second. The thing to remember is that if a capital asset is held, so it's owned more than a year, it's called long term. If the ownership is a year or less, it is a short term capital asset. And that's very important because that will determine how gain or loss on the sale of that asset will be determined. Because long-term gains are taxed at special rates. Now, some of this I'm going to go through a little bit quicker because let's see. So there it is. Generally, all assets except accounts receivable, so that's a business asset. Inventory, again, this is an ordinary business asset because any gains or losses from the sale of these items result in ordinary income. And assets used in your trade or business, including supplies. So now you're looking at your plant assets and your intangible assets. They are not capital assets, and we'll talk about them later in the semester. How do we tax these items when we sell them? So what are capital assets? So you got a understanding. These are more investment assets. Things like stocks you own, bonds, the tax, and when I say you, I mean the taxpayer. So we have stocks, bonds, these are the common ones you're going to see. Land you may hold as an investment. Buildings you may hold as an investment. So that's how you could view it. Investment property not used in a business. When you sell a capital asset, you will look at what did I sell it for generally? So what was the selling price? And you'll subtract from that what you originally paid for it. We call that the basis in taxes. And we'll add to that term basis, but for now that's how you can look at it. Selling price minus cost or basis. When you subtract that cost or basis, the result's either going to be a positive, meaning you sold it for more than what you originally paid for it, resulting in a gain, or it's going to be a negative, which would result in a loss. So first you determine, do I have a net gain or a loss from this sale of a capital asset? Next, determine is it short term or long term, depending on how long you owned it. If after netting those losses and gains together, you end up with a net long-term capital gain. So your long-term capital gains are greater than your short-term capital losses. So what we're saying here is that you've netted together all the assets that were long-term and that were short-term. So the overall amount of long-term sales is a net capital gain. The overall amount of all of your short-term asset sales, are a capital loss. If your net capital gains are, say, $2,000 and your net short-term capital losses are $500. So you got 2,000 in long-term capital gains, 500 in Deductions for AGI we call deductions above the line. The line in taxes is adjusted gross income. So any deduction we can take before having that dollar amount of AGI is a deduction for AGI. Deductions from AGI are referred to those below the line. So we were talking about those. There's two, only two. The first one is the greater of your standard deduction amount, which we're going to show you how to compute, or itemized deductions. Itemized These are your standard deduction amounts. They are based on your filing status, which we're also going to talk about in a few seconds. So then we calculate our tax. Remember, we use special tax preferential rates on items such as long-term capital gains and qualified dividends. These income items are their taxes computed separately from other income and then added. There are other taxes that a person may need to include on their tax return. Self-employment tax, just want to talk about that 2 seconds. That is a self-employed person, so a sole proprietor or a partnerships on Social Security and Medicare tax. Normally, Social Security and Medicare are withheld from an employee's paycheck and employer matches those. So they don't need to worry about them on their tax return. But when you're self-employed in a sole proprietor or partnership, you are not an employee of the business. So no one is contributing money towards Social Security and Medicare. That doesn't mean, whew, you got out of that tax. No, you are required to pay it, but they call it self-employment tax, and you pay it when you file. Well, I shouldn't say you report it. You should pay it throughout the year, but you report it throughout the on the 1040. And there's some other taxes. The net investment tax and the Medicare tax, I think it's going to go away. So I'm not even going to really focus on it too much. Tax credits reduce your tax liability, so the amount you owe dollar for dollar, just like a payment does. And then we have our tax prepayments, which I've already alluded to. Income taxes withheld from your wages by your employer. This is where we report those and deduct them. If you made any estimated tax payments directly to the government to cover your tax liability for the year, which self-employed people have to do, that's where we would report this information and subtract it. If prepayments exceed your liability after deducting your tax credits, you will receive a refund. If the opposite's true, you owe. So let's get into this thing, personal and dependency exemptions. First of all, how do we determine if someone is a personal or a dependent exemption? And then what is the dollar amount? For 2017, $4,050. There are two main sets of rules to determine if someone is a dependent exemption. Personal exemptions are normally for the taxpayer if they cannot be claimed as a dependent on someone else's tax return, and the spouse with the same rule. Okay, so the taxpayer and the spouse, because they are personal, okay, they each get to claim an exemption on the tax return. Give me 1 second. Sorry about that. My book was on the remote for my TV and my TV popped on. Okay. Um, the other type of exemption is a dependent exemption, and that's what we're going to focus on now. When does a taxpayer have the right to call another person a dependency exemption? This only applies to a person who has a Social Security. So animals aren't included here. People have tried it. You can't do it. Citizens, first of all, no matter which set of rules you look at, the person must be either a citizen of the United States or a resident of the U.S., Canada, or Mexico. So if they don't meet that requirement, they are not a dependent exemption. If the person is married, the potential dependency exemption is married, they cannot file a joint tax return with their spouse. So they have to file on their own, their tax return. Except if the only reason they're filing a joint tax return or separately is to get an entire refund of all their taxes that they paid in. So let me give you a quick example here, and you probably should jot this down. We have daughter is married. Daughter is married. Okay. Daughter and son-in-law live with dad. Daughter is 17. She works part-time and makes $2,000. She has $200 withheld as federal income tax. Okay. Dad wants to know, can I claim daughter as a dependency exemption? Now you're going to see as we go through the rules, daughter qualifies. She meets all the rules, except for one thing, she's married. Daughter says, I'm going to file a joint tax return with husband. I owe no tax. So when she went through the tax formula on the tax return, her taxable income was zero. Technically, she doesn't have to file a tax return. She has no taxable income. But the only way to get her $200 back that she paid in through the employer is to file a tax return. So she meets the exception here. So if the only reason the potential dependent who is married is filing a joint return with their spouse is to get all the money back that they paid in because they have no taxable income, they don't fail the joint return test. So this is very unique situations, but it is defined. So no matter which set of rules you're looking at, these two requirements must be met. If the dependent fails either one of these, they are not a dependency exemption. Once you fail a test, once that potential dependent you're looking at fails a test, they are not your dependent. So what are these two categories? Qualifying child or qualifying relative? So a potential dependent, first look to see if they considered your qualifying child. If they fail any of those tests, don't give up. See if they can be considered your qualifying relative. Now, if they fail one of those tests, they are not your dependent. So qualifying child, beyond those first two tests, have 4 more tests. A relationship test, an age test, a resident test, and a support test. Let's take a look at relationship test. A very narrow definition here. It is the taxpayer's son or daughter, or any combination, stepdaughter, stepson, foster child may be eligible, adopted child eligible, or brother, sister, half brother, half sister, or any of their descendants. So going down the family chain. So brother or son, daughter, grandchild, grandson, great grandchild, that's what we're talking about there. Brother, sister, niece, nephew, descendant. So that's it. Mother, father don't qualify. Grandma, grandpa don't qualify. Aunt, uncle don't qualify. Very specific. So if they meet that relationship, they meet that test. Age test. The potential dependent, so this qualified child, must be younger than the taxpayer. So if you're sitting there going, well, if they're your child, they will be. Not necessarily. Stepdaughters or stepsons, not necessarily. Brothers and sisters. Now, so they have to be younger than you. And they are either under age 19, not 19, under the age of 19 at the end of the year. If they are, they meet it. If they aren't, then look to see, are they under age 24 at the end of the year? Under age 24. If they are, they have to be a full-time student, not part-time, full-time. They'll meet this test. Now, if they're 24 or over, the only way they'll meet this test is if they're permanently and totally disabled. That's including if a person is older than you. So, you have a brother, you're 20, your brother's 50, he's permanently and totally disabled. You take care of him. You meet all the tests, but you come to this test, the age test, and you go, "Oh, my brother's older than me. I want to claim him. He's permanently and totally disabled." Doesn't matter. You met the test. The brother meets the test here because of their disability status. And that's certified by a doctor. You can't just go, "I'm totally disabled." Residence test. The person must live in the same residence as the taxpayer. So this qualifying child must live in the same residence for more than half the year. So it is their permanent address. Temporary absences don't count. So if the potential dependent is in school, dorming, if they're in the hospital, if they're on vacation, even the military, none of those things are considered temporary absences. So we're looking at, where's your permanent mailing address? And then the last test that must be met is the child. So the potential dependent here, the child, must not provide more than one half of their own support. It says nothing about the taxpayer supporting them. It just says that the child must not provide more than half of his or her own support. What is support? It's defined in your book where they're discussing qualifying child. It's the wrong tests. There are things like food. Now mine's on page 4-13. I'm using a book from last year. Sorry, I have my other book at school. But it's in that area where they're talking about qualifying child rules, and they didn't change. Food, lunches, toilet articles, haircuts, clothing, recreation, medical and dental care, child care. So it's everything. Wedding costs, lodging, education, except scholarships. So if a child receives a scholarship, in determining their support component, we don't include that. So when we're trying to figure out, did the child provide more than half their support, we ignore any scholarships they received. Okay. So if a potential dependent meets all 6 of those tests for you, the taxpayer can claim that person on their tax return as a dependency exemption. Rodney and Nita have 2 children. Braxton, who's 12, lives at home. Tara, she's 21, full-time student, and does not live at home. While Tara earned $9,000 in a summer job, she did not provide more than half of her own support during the year. Are Braxton and Tara qualifying children of Rodney and Anita? So we're just looking at the test for qualifying children, and what you have to do is remember them and apply them. So we look. They don't include the first 2, which drives me a little crazy. So remember, unless they tell us differently, the assumption is they're either a U.S. citizen or they lived in the U.S., Canada, or Mexico, and neither one of them are married. So those 2 tests have been met. Now for a qualifying child. Relationship. Is Braxton meeting the relationship test? Yes, he is their son. Age test. Is Braxton less than 19? Yes, he's 12. Residence. Did Braxton live with them for more than half the year? Yes, he lived there the entire year. Support. Did Braxton provide more than half of his own support? No. So he meets this test. So Braxton is their dependency exemption on their tax return. Let's go to Tara. She meets the first two, citizenship and joint return test. Now relationship. Yes, she meets that. She is their daughter. Age test. She meets that. She's under 24 and a full-time student. Residency. She does meet that. She's away temporarily at school, as far as we can see. And support. Her parents, yes, parents provide more than half of her support. So she does not provide more than half of her support, of her own support. So this test is met for Tara as well. So she is her parents' qualifying child on the tax return. What happens if you have two parents who are not filing a joint return, or two people who are not filing a joint return, and both meet and determine that a child is their dependent? Who claims the child? You cannot split that $4,050 between the two people. It's either, or however many people there are, it's either one or the other. One person gets to take the exemption. So first we look, is either of the potential taxpayers here that could claim the child a parent? If one of them is a parent, they get the exemption amount. If, say, there's only two people, if both are parents, go to the next one. The one the child lived with longer. The one the child lived with longer gets the exemption amount. Well, what if both are parents and they live together? They're just unmarried. Then we go to AGI. Whoever has the higher adjusted gross income will then claim the child. So, take a look. Braxton's Uncle Sean, so the boy, who is Rodney's brother, so this is Braxton's dad, Rodney, his brother Sean, lived in the Hall's home, the same home Braxton lived in for more than 11 months during the year. Can Sean claim Braxton as a qualifying child? Check this out. Yes, he meets the qualifying child test. Again, we assume Braxton's a U.S. citizen and that he isn't married. The relationship. Does he meet the relationship for Sean to claim him? Yes. He's the son of Sean's brother. Age. Is Braxton less than 19? Yeah. Did they live in the same home? Sure. More than half the year? Yeah, 11 months. Support. Does Braxton provide more than half of his own support? No. So Sean can potentially claim Braxton as a dependent. However, he won't in this case because there's your answer, Rodney and Anita. But that's just to show you that another person who isn't even a parent can have the ability to claim a dependency exemption for a qualifying child, even if they're not their direct parent. Okay, so what if any of the rules failed? Well, we don't give up hope. We have more rules for a different classification of a dependency, and it's called a qualifying relative. Now, remember, you still need to meet those first two that we talked about in the beginning: U.S. citizen and or resident. And if the potential dependent is married, they don't file a joint return with their spouse unless it's to receive all of their income taxes they paid in back. Meet those first two tests. Now let's look at three more tests. If they meet these three more tests, you have a dependency exemption taxpayer. Relationship test, support test, and gross income test. The relationship test, much wider view than a qualifying child. Now we're including mom and dad, grandparents, great grandparents, etc. So it's a descendant or ancestor of the taxpayer, a sibling of the taxpayer, son or daughter, brothers of the son or daughter of the taxpayers. Cousins are not included in this definition. A sibling of the taxpayer's mother or father, or in laws. An unrelated person. So someone who doesn't meet this definitions above, or and this includes a cousin. So they're considered an unrelated person, but they live in the taxpayer's home the entire year. They would meet this test. So it doesn't have to be just a relationship test by blood or marriage. It could be someone, a total stranger who lives in your home the entire year, taxpayer. They'll meet this first test. John is a 22-year-old student who has lived in the dorms for most of the year, but spends the rest of the year living with his parents. He earned a $5,000 scholarship for the school year and has worked hard to support himself through school, earning $6,000 to pay for his own expenses. His parents have supported him by paying $7,000 for food, clothing, and lodging. Are John's parents able to claim him as a dependent? Well, first we look at the qualifying child. Does he meet the relationship test? Yes. Does he meet the age test? Yes. He's under 24 and a full-time student. Does he meet the residencies test? Yes. It's temporary absences only. And does he meet the support test? He does not provide more than half of his support. His parents do. So this test is fulfilled. So ignore that gross income test. That only is for a qualifying relative. So he is their qualifying child. At this point, John's parents would say, done, he's a dependency exemption. But what if he failed one of these tests? Well, let's go to qualifying relative. Remember, there's only three tests here. Do they meet the relationship test? Yeah, John's their child. Do, does his parents provide more than half of his support? Yes. Okay, so you got to be careful of that. Take a look through all the examples in the book and post any kind of questions you might have on determining dependency exemptions. Also, be aware that there's a great flow chart at the end of the chapter in the appendix, which will help you sort through if someone's a dependent as a qualifying child or a qualifying relative. Moving along, filing status. How do we determine a person's filing status? Well, there's only 5 to choose from. They're married filing joint, married filing separately, a qualifying widow or widower, they're single, or they're head of household. Married filing jointly. Marriage status is determined as of the last day of the Married filing separately. Taxpayers are married but decide to file a separate tax return. I've never really seen this happen in the real world, but some people do it. The reason it's usually not done is because it gives the worst tax position. So you pay the most taxes if you're married under this situation. Qualifying widow or widower. This is available to someone whose spouse died and they meet these circumstances. Now remember, in the year of death, you file a single. This is the last status you look at. If you don't meet any of the other statuses, you're single. Essentially, you're unmarried. Now, you can also be unmarried and qualify for head of household. So you've got to meet all the rules though. And this is a better status than single because less income is taxed at the different rates. So there's the qualifying child and qualifying relative information I just talked about. Now, certain married people may be able to claim head of household status if you are considered what we call an abandoned spouse, an abandoned spouse. This is you're married at the end of the year legally. You don't file a joint tax return with your spouse. You pay more than half the cost of maintaining a house where a qualifying child lives for more than half the year, and your spouse has not lived with you in the past 6 years. You're truly looked at as abandoned. You can't find that spouse. If you can't find them, what are your choices? Married filing jointly, which you can't. or married filing separately, which puts you at a strong disadvantage tax-wise. So a head of household was made available to people who meet this qualification to help them with their tax burden. They're still married, but their spouse is nowhere to be found. So if a married person meets and can prove these circumstances, they can file head of household. So let's take a look. Assume that last year Rodney passed away. During the current year, Anita did not remarry but maintained a household for Braxton and Tara, her dependent children. Under these circumstances, what would Anita's filing status be? Qualifying widow. Remember, he died last year, so she filed a joint return with him last year. This year, she has qualifying children, lived in her home for more than half the year, and she did not remarry, so she files under qualifying widow. Assume Rodney and Anita divorced, though, last year. During the current year, Braxton lives with Anita, and Anita pays all the cost of maintaining the household for herself and Braxton, her son. Under these circumstances, what is Anita's filing status? Well, first of all, let's look to see, is Braxton her dependent? Let's look at the qualifying child. He meets the relationship test, he's her son. He meets the age test, he's only 12. He meets the residency test, he lives with her for more than half the year. And he does not provide more than half of his own support. So he is her qualifying child. Now, she's not married, she's unmarried. Let's see if she meets the head of household roles. Does she maintain the cost of a home and does she pay more than half of those costs? Yes. Does she have a qualifying child or relative living with her that's not a parent? Yes, Braxton. Guess what? She's head of household. Assume Sean, remember Uncle Sean, lived with the Halls, but Sean paid more than half the cost of maintaining a separate apartment that is the principal residence of his mother, Sharon, whose gross income is $1,500. Sean provided more than half the cost of Sharon's support, and because Sharon's income was only $1,500, she qualifies as Sean's dependent, qualifying relative. Now, let's go through those tests again. She meets the first two, U.S. citizen, and she's not married. She meets the relationship test as a qualifying relative. She's his mother. Sharon's his mother. Okay. She meets the income test. Her gross income is only $1,500, much lower than $4,050. Okay. And Sean provides more than half of her support. So she is his qualifying relative on the tax return. Now, Sean is single. Let's see if he can file head of household. He maintains the home of his mother. He pays more than half the cost of maintaining the home of his mother. Normally, the qualifying relative or child must live with the taxpayer. But if it's a parent, there's an exception. As long as Sean is providing more than half the cost of his mother's home, he qualifies as head of household here. Sean paid more than half the cost of maintaining a separate household that is the principal place of abode for his mother. And the only reason this happens for Sean is because it's a parent. So if this was his mother or father, they're a qualifying relative. He pays more than half the cost of their home. There you go. Okay, so really read through those and practice those. The final area of our discussion is with standard deduction. And this is on page, it's 632 through 634. I'm pretty sure of your book. Sorry about that. Yeah, it looks... But it is the standard deduction and exemption area. Learning Objective 3, LO, Learning Objective 3. Exemption amounts are one deduction for AGI. So in that last discussion, we figured out how many total exemptions a taxpayer would have. Multiply it by $4,050. They get to deduct that amount from AGI to determine taxable income. The other deduction from AGI is the greater of the standard deduction or itemized deductions. So we're just going to look at standard deduction amounts. Now that we understand filing status, we can now tell you those amounts. So depending on your filing status, we'll determine what we call your basic standard deduction. So married filing joint and also qualifying widow or widower, $12,700 in 2017. Head of household status, your standard deduction $93.50. Single and married filing separately $63.50. Now next to that, it says additional standard deduction. Yes, you are allowed an additional standard deduction if you are at least 65 or over as of the last day of the tax year. So 65 or over, add, if you're married filing joint, $12.50. So if both spouses are 65 or over, they would add it twice. And blindness also qualifies for an additional amount to the standard deduction. So if both spouses are blind and over 65 or over, they would add $12.50 4 times to their married filing joint basic standard deduction. Now, what you have to be careful of, and the most common mistake here, is that people start applying this additional deduction to their dependents. No. Standard deduction applies to the taxpayer and spouse's circumstances only. For instance, let's say we're looking at Sean in our prior example. Sean can claim head of household. Sean is 40 and isn't blind, but his mother is 80 and blind. Do not add any additional amounts to Sean's head of household standard deduction. It applies to him, not his dependents, and that's what we're talking about there. I'll be right up. The other thing you want to be careful of is if someone can be claimed as a dependent on someone else's tax return, their standard deductions do not follow this table. So the assumption here is that the taxpayer who's going to claim the standard deduction can claim themselves on their tax return. For those of us who can't claim ourselves on our tax return, we follow the rules at the bottom of the page. It says this: to determine your basic standard deduction, you take the greater of $1,050 or your earned income being how much money you make at your job, plus $350. So let's say you have this situation. You could jot this down. You have Susie, who can be claimed as a dependent on her mother's tax return. She works a job and makes $2,000. Susie's mother doesn't report Susie's income on her tax return. So we don't put our dependents' income on our tax return. No, they file their own tax return. The most people that could be report on a tax return are spouses. That's it. So Susie needs to file her own tax return, even though she can't claim herself, and she has to figure out her standard deduction. Well, it will be the greater of $1,050 or the $2,000 plus $350, or $2,350. So $2,350 would be her basic standard deduction. Now, if when we did that computation, her standard, the $1,050 or her earned income plus $350. So if her earned income plus $350 is greater than $6,350, the amount of the normal standard deduction for a single person, we would limit it to the $6,350. So that computation we just did could never be greater than this normal table amount. That's the first thing. The other thing is this: we computed the basic standard deduction. If Susie is blind or over or 65 or over, she can add additional amounts, the $1,550 for each occurrence of that. So this isn't her total standard deduction we determine, it's her basic, add for each occurrence of being blind or 65 and over. So I know I kind of wrapped that up in this whole slide, but take a listen through this again, practice it a lot, look at the examples in the book, and then ask any kind of questions you may have. So I thank you for listening, and good luck.